Hey, everybody. Thanks for tuning in to our Master the Market segment. So, wow, last week was something. It started with what we call the Wallop. Christopher Waller, Fed governor, came out and said, hey, the Fed should probably be methodical and proceed carefully on cutting rates. And so that remark met some economic data that was better than expected, including initial jobless claims, which came at historic lows, as well as retail sales. So the good news is bad news for bonds. And so that took the chance of a rate cut in March, a probability of 80%, now down to a coin toss at 50%. So if you're wondering why, rates spiked, that was one reason. The other reason is the debt. On Thursday, the Treasury announced they're going to sell $160 billion worth of 2, 5, and 7-year notes this week. And so we have to contend with that as this week proceeds. And the big news for us, unfortunately, is that the 10-year note moved above its 200-day moving average, something we talked about over the last several weeks. We didn't want to see it happen. Well, it did. And so now as a mortgage professional, you got to watch that very, very, very carefully. Listen, the other part we're watching this week, which could change everything in a second, is the Fed's favorite gauge of inflation, the core PCE. If that number shows that some of the shelter components, which make an outsized portion of inflation, if those components come in a little lower, that could really drop that reading, and that could change everything quickly. Obviously, the opposite is true. Have yourself a great week. We'll talk to you soon. Bye for now.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.